Hello my fellow investors and welcome back to another earnings report video. Today guys, let's analyze the company Beyond Meat. Now they just had earnings as if I'm recording this a few hours ago, as you can see right over here. They did have earnings after close, and man, okay, this is a company that I've only done a few times here on the channel, and I gotta say, it was a very hyped company back in the day. At least that's what I believe. I haven't taken a look at their graph yet, but that's going to be an interesting one though, because I do believe though that they were very hyped. And well, a lot of people thought that this company was going to go to the moon, and unfortunately it did not. Now, when it comes to their actual products, I am not the biggest fan when it comes to plant-based foods. Me personally, you can't take away from a good hearty steak, right? You just can't do that. Nonetheless though, to his their own. If some people like this kind of food, then by all means, do you, right? But with me, when it comes to the products, I prefer going with the real thing. Nonetheless, though, we're here to analyze numbers. So let's take a look at this company and see if the current share price is looking like a good buy, as well as to see if the fundamentals are any good. So starting with the earnings summary, we got over here Beyond Meat GAAP EPS of -83 cents, beats by a penny. Oh boy. That's already not looking good. Revenue of $102.15 million, misses by $7 million. So right there, this thing is already just bad, right? We already know that when it comes to the PE, that's going to be an NA because of the fact that, well, negative net income, right? Of the EPS, right? EPS -83 cents, so negative net income. And on top of that, that miss in revenue isn't necessarily good. However, that miss is based on analyst estimates. I want to take a look at the year-over-year number. However, if you guys are looking at this right here, this is not looking good. So let's come over here and take a look at their actual earnings report. And like always, this will be linked in the description below. So we got second quarter 2023 financial highlights. Net revenues were $102.1 million, a decrease of 30.5% year over year. Wow, that is not good. Gross profit was $2.3 million, or gross margin of 2.2. Net revenues compared to a loss of $6.2 million, or gross margin of -4.2 of net revenues in the year ago period. Net loss was $53.5 million, or 83 cents per common share, compared to the net loss of $97.1 million, or $1.53. Okay, so at least they're losing less, right? They're losing less, right? Going from a loss of $97 million only down to a loss of $53.5 million. That is better, but man, that's still a huge loss. Adjusted EBITDA loss of $40.8 million, or 40% of net revenues, compared to the adjusted EBITDA loss of $68.8 million, or -46.8% of net revenues in the year ago period. All right. Now I want to take a look at what the CEO actually had to say. Beyond Meat President and CEO Ethan Brown. I don't know if this is the guy that bit a dude's nose off or something, but that was a thing like a few months ago. The second quarter brought mixed results amidst otherwise strong progress towards our goal of sustainable long-term growth. Ongoing category headwinds compressed net revenues, which in turn impacted product sales, mix, and gross margin, overshadowing significant strides in operational efficiency, including meaningful year-over-year reductions in our operating expense, COGS per pound, and overall cash consumptions. While we are reducing our full year, that is not good. While we are reducing our full year 2023 net revenues outlook, we nevertheless expect a modest return to year-over-year top line growth. Oh, that's awful. So they just completely just destroyed. The fact that they just reduced their 2023 outlooks when it comes to the net revenues, that's very massive, right? That's very massive. But he goes on to say, in the third and fourth quarters of 2023, and relative to the first half of 2023, a meaningful reduction in cash consumption and an increase in gross margin. As we look to the future, we remain steadfast in our belief that plant-based meat and Beyond Meat specifically will play an important part for global response to climate crisis that appears to rapidly intensifying, while also delivering health benefits in individual consumers. All right, well, I don't know about all of that, but all I know is that these numbers do not look good at all. So let's jump into these numbers right here. So we got over here their net revenues when it comes to pretty much each individual segment in the United States, mainly in the United States, okay, and international as well. Okay, so we got over here US retail we got, ooh, look at that drop. Oh my lord, look at that drop from by the way, this is in thousands, so this would be 78.86 million down to 48.49 million dollars. That is look at that decrease, 30.37. Again, that's a change of 38.5%. Food services went down a massive amount, guys. Look at that, 23.4 million down to 12.76 million. That is a decrease of 45%. US net revenues 102.25 million to 61.25 million. Guys, another decrease of 40%. All of these are just decreases. Internationally, they fell, but they didn't fall as much. You can see over here that when it comes to the international, the retail was around 15.6, the food services was less than 1%, and international net revenues fell only 8.10%. Overall, though, net revenues fell around 30.5, but again, in the United States, this thing is just completely crashing hard, right? And by the looks of it, the United States does seem to make, actually, it does seem to be a little bit of 50-50, right? Yeah, I think it does, because like international net revenues of 147, actually, I guess international is a lot bigger than the United States, so that makes a lot more sense, but they're still pretty comparable to one another. All right, so I wonder, do we have over here the outlook? That's really what I would like to see over here. If we see outlook. So we got over here the 2023 outlook. They did say that they did bring this down. So the company's operating environment continues to be affected by uncertainty related to macroeconomic issues. Okay, including softer demand in the plant-based meat category, higher inflation, rising interest rates, and ongoing concerns about the likelihood of a recession, among other things. All of which have had and could continue to have unforeseen impacts on the company's actual realized result. That right there is huge, guys, because, well, look at what they're mentioning first. Softer demand on plant-based meats. Fact of the matter is that these plant-based meats, they're going to cost a lot more than your normal meat, right? So when people are struggling, guess what? They're not going to go for the fancy, thing. They're going to go for like the cheapest thing, right? It's either get the cheapest thing and keep the lights on, or pay an extra however amount for a fancy food when you really don't have the ability to afford gas, right? So it's either one or the other. But looking at this, we got net revenues are expected to be in the range of approximately 360 million to 380 million, representing a decrease of 14 to 19% compared to 2020. Wow, I think we should just stop there, right? But if we keep going on, gross operating margins, whatever, operating expenses are expected to be 245 million or less. Capital expenditures are expected to be in the range of 20 to 25 million. With respect to the company's previous stated target of achieving cash flow positive operations within the second half of the year, in light of greater than expected consumer and category headwinds and their anticipated impact on net revenues, the company now believes this is unlikely. Oh, that is awful. Wow, they were expecting positive free cash flow, and now they're like, nope, we can't do that in the same time frame because of everything that's been happening. So yeah, this is major news, guys. Again, linked is in the description below if you guys like to read the rest for yourselves, but right then and there, this is not looking good. So with that said, let's jump now into the calculator and let's take a look at this at a much wider scale. We got the ticker for BYND. Market cap is $981 million with a PE of NA. And yeah, I mean, we saw their earnings, right? We saw the EPS is in the negative, so that's not surprising. Current share price of $15.28. If you take a look at this graph, this thing is down 61.13% on the 1 year. Year to date, it is up 23.42. However, I want to take a look at this during COVID because I do believe that this was a major hype company. And yeah, look at that. Actually, this was back in 2019. So, wow, look at that. Actually, this thing was $193. Bruh, this thing was $193 in October 8th, 2020. And that wasn't even, hang on a minute. Let's take a look at the 10-year. Wow. Okay, so the peak was here. The peak, oh, hang on. Let's go to advanced. Let's go to advanced and let's take a look at this on the 5-year scale. There it is. So what was that peak? Hang on a minute. What is that peak right there? $235. Bro. People who bought this thing right here thinking to the moon, look at this. Look at what it is right now, $15.28. And intraday, this thing fell almost 3%. And post-market, this thing has fallen even more to, oh my God, 11.5%, $13.52. Wow, we are pretty much near 52-week lows on this one, guys. $9.82 and a 52-week high of 44, but this thing was even higher. This thing was, I mean, I just showed everybody. This thing was as high as like what, 200 something to $220 or something. That's crazy. $222. That's insane. Again, to the moon? Not really, right? Not really. Because again, every investment is the present value of all future cash flow. Now, let's take a look at these fundamentals, shall we? Let's come back over here. They don't pay the dividend. So, you know, all of this is going into themselves, the free cash flow. But we just read that they're not going to get into positive free cash flow anytime soon. Now, let's take a look at these fundamentals, right? Because, I mean, were you able to avoid this thing? Were you able to avoid this massive crash, right? That's really the question. And, again, we only got the 5-year scale. Guys, 5 years ago of negative 29.9 million to today of negative 366 million. That's a decrease of 1,124%. All right, aside from the 4-year ago increase, guys, this thing is just bad, right? This thing is just bad. So I'm going to give this thing a 5%. Again, the 5 is just because of the fact that they increased it from 5 to 4. But aside from that, it's pretty bad, right? It's very, very bad. Looking at the free cash flow, they just said that they were not going to get positive. Like, they're not expecting to get positive free cash flow anytime soon. We got 5 years ago of negative $61 million to 1 year ago of negative $393.5 million. That is a decrease of 545% from an average of negative $216 million. The worst year was 2 years ago, and I'll give them that. You know, they're at least breaking this up from 2 to 1 year ago very, very slightly, but still, I'm going to give this thing, guys, a 5%. This is not looking good at all. Now, the revenue actually isn't looking too bad, right? However, we just saw that 2022 to today, that was a decrease of 30%. Now, this revenue looks really, really good, right? However, you could see that there was a massive drop from 2 to 1 year ago, right? Nonetheless, though, on the 5-year, this is an increase of $87.9 million to 1 year ago, let's just say $419 million, increase of 376%. But if we just saw a decrease in their net revenue, right, when it came to 1 year ago, so this year, this value right over here, of 30%, this is telling me that when we get this year's value, this thing will probably be a lot lower than even 2 years ago, right? So that's concerning. However, the graph doesn't necessarily look too bad, but we have to take everything, guys. So I'm actually going to give this thing, I would say at around like, I'm gonna say at around like a 15%. Looking now into the assets minus the liabilities, I mean, this thing, it was positive from 5 to 2 years ago, but then as of recently, it's gotten into the negative. They're piling on debt, but I guess you can make the case that real growth companies, so therefore, but I don't necessarily like this one bit. Now, average total assets, 869.62 million. Average liabilities, it is 784.22 million. Doing this difference, we get only $85.4 million. This is a little bit difficult. I'm gonna say at around maybe like a 25%. You could even argue. Actually, I'm actually not going to say 25%. Let's say with 20% on this one, because this is so close, and you can see as of today they're even going lower. So actually, you could even say less, right? You could even say less, but I'm going to leave it at 20%. Now, the cash flow minus the liabilities. I mean, their cash flow isn't looking good. This thing is coming down. As of 1 year ago, it's not the lowest point, but still, it's just horrendous. You can see that the average, it is negative $763 million. The 1 year ago value, it is negative $1.66 billion. So I'm going to have to give this thing, I'm going to give this thing a 0, guys. This is really, really bad. Now, the shares outstanding. If this thing isn't increasing at a massive rate, then I'll be very, very surprised. But as we can see, wow. Okay, that is a pretty big increase. You can see here that 5 years ago, when it comes to the shares outstanding, 7 million shares to today of 64.2 million shares. There's an increase in the 5 year of 817.14%. However, you can see that this main increase happened 1 year ago. Well, not 1 year ago. Only happened in the past 5 to 4 years ago. That's it. So there was only one major increase, and after that, don't get me wrong, they have been continuing to increase it at a pretty steady rate at around 0.63, honestly. By the way that this looks, it does look pretty consistently. So I'm going to take this more into account than this spike. But by the looks of it, I think they might issue a lot more shares in the future. So yeah, just keep that in mind. Overall, though, this is looking really, really bad at 0%. And lastly, cash and equivalents, they currently hold $258.6 million with an average of $298.53 million. looking at the overall grades, I mean, okay, we just gave this thing 2 zeros, 2 5s, a 15 and a 20, right? So overall grade of 7%, guys. I get that it's a growth company, I get that, but usually growth companies are supposed to actually grow, as opposed to this company, which reached the peak of, what, $222 back in 2019, and people said to the moon. Now, don't get me wrong, even during COVID, it went as high as 192, right? I mean, it went as high as 192, 190, more than once, and today, well, the numbers dragged it down because every investment is the present value of all future cash flow, and their cash flows are, well, not in the positive. In fact, they won't be cash flow positive for a while, according to them. So 7%, this is not looking like a buy at all when it comes to fundamentals, and of course fundamentals should drive everything first. However, for video sakes, let's see if at the current share price this is looking like a buy. So looking at this, we could see that right off the bat, $39.65, not adjusting for debt, and adjusting for debt, $29.29. So right then there is looking great. However, these numbers are not going to look pretty. So let's start with the projected share buyback first. Now, 0.63 issuing of shares. It's very, very consistent. So I'm going to say, by the way, that's in 1 year span. So if we do 0.63, multiply that by 5, that will essentially get us the overall. Oh, actually, I just realized that is, oh man, hang on a second. What is, oh man, hang on a second. What is 0.63? Let's bring out the calculator because I'm not fully sure. So what is 0.63 times 5? That is, so it says 3.15. So yeah, that would be 3.15%, right? That would be 3.15%. So that would be 3.15% for the issuing of shares. Actually, let's just bring this down to essentially 3, right? So that'll be issuing of shares. That'll be a -3 issuing of shares in the next 5 years. Okay, now for the lowest assumption, let's go down by 3 again, right? So let's go with -6, and then for the highest, let's just go with 0. Let's just assume that they won't issue, or let's just say that they won't issue any shares, right? Issue or buy back any shares. Now, okay, here's the thing with this, right? What comes down to this is now the revenue. So if we come over to Seeking Alpha into the growth tab, we can see that this, sorry about this, this revenue forward is 2.5% in the negative. All right, so 2.5% in the negative. I have to take worst case scenario. I'm going to say, dude, they just did 30% in 1 year. So I'm going to say, again, this is in the next 5 years though. So worst case scenario, they're expecting negative 2.5%. Therefore, I'm going to say it around maybe like negative 14. Yeah, I'm going to go big, guys. I'm going to go big. Negative 14. Let's say, again, the recession, or at least the impacts of the high interest rates, are just beginning, according to the Fed. And what is one of their main concerns? High interest rates and high inflation. And we also have seen gas prices go up as well. So I'm going to go all out on this. So let's say now negative, let's, yeah, I guess let's say negative 10. Right, and then let's say at around negative, what is it, -6. So there we go, guys. With this assumptions, we can see that the target share price is $22 to essentially $31, and then adjusting for debt, $12.20 to $21.44. With the margin of safety of 5, 10, and 15, you got $10.37 to $20.37. So based with the current share price of, it's not $15.28 though, the current share price of what, $13.52. This actually may seem like a buy in a few areas over here, right? In a few areas. So, yeah, I mean, I'm looking at this, I'm just like, it may be a good buy in accordance to this. However, guys, again, this should drive everything first. If this does not fall into place, then to me personally, this doesn't mean anything, right? Because, I mean, just look at this. This thing fell from a peak of like $200, $222, and people were like, oh my God, to the moon. In fact, I'm fairly certain that if I would have said this thing should be worth, you know, like $10, people would have been like, oh, it'll never fall there. And it fell there. So I'm looking at this, I'm just like, yeah, no, fundamentals just aren't there. I guess this is looking like a good buy, but again, if the fundamentals aren't there, I don't really care what this necessarily says. So That's just my personal opinion. Obviously, you guys should do your own due diligence. This is not due diligence. That's why I link everything in the description below, including the earnings report as well as these calculators if you so would like to use them, right? The only thing that we ask for in return is actually just something free back. And that is just you guys supporting the channel by liking, subscribing, commenting, and of course, sharing. Thank you all so much for everybody who's done that. Yeah, guys, thank you all so much. I mean, we're really close to 3K subs. Let's see if we can actually get there by, I guess, by September 3rd. I don't think so, but if we do, Mike said that he will begin to do face cam. So he really actually wants to do face cam. So if anything, he'll probably push that goal out, but still though. Let's see if we can get that, guys, to as close to 3K by September 3rd as much as possible. All right. Now, believe it or not, when it comes to options, this thing is actually really good when it comes to options, man. For some reason, look at this, especially on the call side. This is just insane. You can sell a covered call on this for what, $15.50 for $110. And honestly, if you guys would like to get rid of this, seeing that you don't want anymore, you know, start selling covered calls. Like, actually, you could honestly, if you bought this thing at like around like $9 or so, I would just sell in the money covered calls, right? And let them expire in the money, right? And you make that capital gain, obviously, if you bought it at a lot lower than the current share price. So you get that gain, and on top of that, you get a pretty big premium. Like if you think, like if you bought this thing at like $9 and you want to sell this thing, well, I guess now $13.46, but if you want to sell this thing at 13, okay, you're gonna get a little bit of a gain there, right? But you're also going to get $250 essentially. Of course, as if I'm recording this, by the time you guys see this will be different. But yeah, like on the call side, this is looking really good. Again, if you want to get rid of this company because you're looking at the fundamentals and you're like, oh man, I made a big mistake, and you bought this thing at a lot lower than the current share price, then again, consider selling in the money covered calls. Now for the put side, it's actually not that bad either, but again, be very careful. This is very volatile right now. I mean, right now it's almost down 12%. All in all, Beyond Meat, again, I'm not really a fan of plant-based foods. I prefer the real thing. I love my hearty steak. I really do. So, you know, I personally will never eat one of these things, at least not willingly. Like if it's given to me, you know, whatever, I'll eat it. But aside from that, I'm really not interested. All in all, though, when it comes to the numbers, yeah, this was a very hyped company. Yeah, sorry if you got into this, but again, if you want to get rid of this company and you're still in some kind of gain because you bought it at like $9, well, consider selling a covered call. Obviously, that really is up to you. I'm not telling you guys what to do, but again, if you would like to get rid of it, in the money covered call, make that gain as well as a nice premium. All right, guys, so that pretty much is for this one. Y'all can follow us on the YouTube sites, link is in the description below. So with that said, peace out, and we'll see you all next time.